right, welcome back to another episode of Real Deal Investing, hosted by myself, Larry Mastropieri, a local real estate broker here in South Florida, and Jerron Kelley, my co-host. He is partner and owner at Kelley Grant and Tannis, PA. He's a local real estate attorney, and our guests here today are Sebastian Zaba with Steneth Capital and Dr. Leon Stenneth. Welcome, also with Steneth Capital, and we're going to get into a whole bunch of stuff regarding investing and syndication. So let's start with Sebastian. Introduce yourself and tell us a little bit more about how you ended up in this space and what's going on. What are you guys up to?
Yeah, sounds good. Both our backgrounds essentially in engineering. So we actually met at our previous job. We worked together for about 8 years. He was running the research team. I was running the engineering team. And then we kind of had a really good synergy working together, working on, the back-end systems for self-driving cars for like Audi, BMW, and Daimler and such. And been doing this for a while. And then actually right before COVID, we started trying to do our first joint venture. It didn't work out, because of the situation that was happening. And then we revisited that whole thing last May. So almost a year ago, Leon asked me, hey, come on board, let's do this. So I kind of jumped on because we worked well together. And I usually come in to scale anything from software to teams to investments, whatever it is. And I think we've really taken off since I came aboard, because now our cadence is probably 10 to 20 doors every other month now. We just closed our deal on February 1st, and we're the contract for our next deal. Be closing, just working out, negotiating right now. It's going to be closing probably April, I would assume, right? So yeah, I got into the space. Always interested in it. Leon kind of paved the ground for me to just jump on and kind of just scale operations. So it's been fun since.
Well, when we first met, you were relocating from Chicago, right, to South Florida, and I helped you purchase a home down here. And you've expressed interest over the years in investing, and that's kind of why we vibed too, right? Because I've had some investment background here. I own about 100 apartments in the area now, and you purchased your home, and then continued the path of trying to figure out, how do I get into this real estate investing space, right? Yeah.
Yes. I mean, to your point, right, we kept looking around here and it was just not within the margins that I want to invest in, right? Those are kind of, Florida market seems like it's, buy and hold, has dividends. But the stuff we're doing is a little bit more cash flowy.
Yeah. And I want to get into that too, but we'll let Dr. Leon, sir, we'll let you tell us your background. I like that. I call people doctor all the time, so I think it's great that you have that in your title.
Well, I especially love Leon because that's my middle name. So
there you go.
As I was telling you before, though, the only problem with the Leon is my whole childhood, whenever I'd get in trouble, my mom would say, Leon, come over here. Why didn't you finish your chores or whatever it was? It was always a cringeworthy moment. So I got a little visceral reaction to Leon. So, but still love it.
Yeah. So in terms of my background, I was born and raised in Jamaica, and that's where most of my my extended family is. My mom, my brother, and so on. And I came to Chicago primarily to study a PhD in computer science via the Fulbright Scholarship. Before that, after Jamaica, I also spent some time on the other side of the Atlantic in London. And that's where I was studying a master's degree in computer science on a European Union fellowship. So when I came to the US, it was during the massive recession. And, 08, 09, and property prices were ridiculously low. And at the same time, there was a lot of foreclosures. So that's when I saw the opportunity to purchase the first property in Chicago. So I was in school studying for the PhD in computer science. And at the same time, I had a property that was bringing in income. And that's how I started. And ever since, every year or every 2 years, I would kind of add to the portfolio until I realized suddenly that, maybe I have a business. And while working at Here Technologies, working on self-driving cars, that's where I met my dear friend, Sebastian Zaba. And this is a bit of insider, but I was running the research team. Zaba was running the engineering team. Traditionally, researchers and engineers, we have different KPIs. We want to make sure that things are, 99% accurate, 99% working. Engineers are good with 80-20. So researchers
A little
and
jab right there at us, Zaba.
We have to make money, right? We have to kind of move forward
There
with
you go.
stuff. So
Engineers just want to get it done and move on. That's it. Yeah.
Yeah, so traditionally, when researchers and engineers are in the room, it's always like, bumping heads, trying to find the middle ground and so on. But I found that Zaba and I strike very good relationship, very good understanding. Our teams were working well together, and people in the organization would talk about it's the first that they are, witnessing, researchers and engineers living so good together, just cranking out work, cranking out patents. During that time, researchers and engineers had their names on patents together. Before that, it would just be the researchers. So Zaba and I, we kind of, I would say, strike a great relationship. And I kind of took note of that. And we tried to do some joint venture before the pandemic, but no one knew that they would be living today. So we kind of called it off then. And after the pandemic, we kind of synced up again. And I knew Zaba's ability in terms of scaling teams, scaling products, building relationships. So that's when we start to partner, which is sometimes last year, where we acquired our first property, which was 6455 South Richmond Avenue in Chicago, very close to Midway Airport. And this was a 10-unit property, so 10 apartments.
So let's give the viewers just a quick high-level overview. So you started investing in like 2009. When did you buy your first property?
Yeah, around 2009, I would say.
Okay.
Yes.
And
that's my first property in the US. Yes.
Okay. And then today, how many apartments, how many doors do you guys own?
We are around 360 doors, I would say.
Giddy up. Awesome.
Good job. Yeah.
And how many syndications have you, and you're syndicating for each deal individually, right? So how many syndications have you guys closed since then?
So we have only done one syndication so far, and we closed that one on February the 1st.
Congrats.
Before we were doing joint ventures between Zaba and I and maybe one other partner. And before the joint venture, this was just predominantly me.
Got it. And so how many doors do you own individually?
I would say just over 200.
Okay, so you individually own about 200 apartments.
Yes.
In the Chicago area. Right?
Yes.
And then so you got a good experience base already at operating these things, and then you started doing the joint ventures and now the syndication deals.
Yes, and when I started, I was using a third-party management company. They had boots on the ground, and they own and operate over 1,000 units. And their name is Sharp Rose, and the owner was Trent Anderson, very nice guy. So he kind of mentored me and showed me a little bit about property management. And that's when I kind of get curious into, realizing that, yes, if I could really do the property management in-house, then there would be lots of lessons learned, but also we could also save some money as well and use that money towards the scaling. So last year, we started to do in-house management where we utilize Upfolio property management software to manage our portfolio. And it's been very efficient since. We have tenants being able to pay online, tenants being able to submit maintenance requests online. we have an entire feedback loop system where when a tenant submit a maintenance request, then we can also ask them for a review of our work. So it's really, there is a feedback loop involved. And first syndication, as I said, was actually closed this year.
And are you guys investing in the same area, or are you looking elsewhere in the country? Are you looking elsewhere in the city? Do you have a specific niche?
Yeah, so our strategy is to invest in growth markets, and we're also looking into opportunity zones as well. So we tend to invest in clusters. So we have one cluster that is close to the Midway Airport. And in this area, you have smaller buildings, say between 10 units to 20 units, but you have a bunch of single family homes as well in this area. A lot of employment is high in the area due to Midway and other industries that are close by. We also have another cluster of properties very close to the lake. So these are what we call our point of interest, like the airport, for example, the lake, for example. And this is Lake Michigan. And in this cluster, we have, say, bigger units. So buildings up to 45 doors. And now we're also looking to form new clusters as well. So yes, we're looking forward to expand mostly in Chicago, but we're also evaluating other markets as well. Dallas, Texas, Houston, the Carolinas, Atlanta, Georgia. Those are under evaluation.
Oh, interesting. Okay, so you're kind of expanding beyond your core geographic competency right now. Is that?
Yes. And we are running evaluation now to identify property management services outside of Chicago and kind of ranking them and going through their reviews, so that once we do acquisition in these other regions, then we have a property management partner that we can piggyback on.
Got it. I'm curious how you ended up, getting the confidence to go invest in real estate like this. Because what type of product are you investing in? Like in 2009, 10, what did you buy? What type of asset was it?
So in 2009, the first acquisition was a condo. It was a garden unit, and this was on the north side of Chicago. So very good neighborhood. But as I said, it was a recession. So I think I paid maybe $50,000 for this unit. But I can tell you, it required a lot of work. It was completely molded, underwater. And I had to, find a contractor to kind of bring it up to market and to get it rented. But I never lived in this condo. It was always an investment for me. So yeah, go ahead, Larry.
So nicer neighborhood then. Like you started in like a nicer neighborhood. Did you buy this? Was it advertised off the MLS, or did you buy it through a realtor?
Yeah, I bought it through a realtor, and I can provide a lot of details. So when I just moved to Chicago, I was looking for a place to live as a student that's here to do a PhD. But wherever I look for places, they would ask for my credit score. But I didn't have any credit scores yet because I just arrived. So then I had to show my bank statement to show my capabilities to pay the rent. So when I showed the realtor my bank statement, that's when she said, hey, she knows of a place where, I could kind of invest this money as well. So that's how we started to search for investment properties. And she kind of knew the land more than I do. She's been here for many, many years, maybe 20, 30 years. And she's the one that kind of helped me to select the property, helped me to identify a contractor, helped me to get the place rented and so on.
Got it. And then the next step was, after you got through that one, what did you buy next?
Well, after I got through that one, then my approach was for me to kind of rent it out, forget about it, and focus on studying. So I kind of focused on studying for maybe a year or two, and I realized that the income from this property is really helping me to survive as a PhD student. And then I said, maybe it makes sense for me to kind of, invest into another property. So I would save up the rent from there, save up my stipend from the research assistant role as a student. And then my next acquisition was a 5-unit property that's very close to the university.
Good neighborhood, bad neighborhood. What type of
neighborhood? Yeah. Good neighborhood. Very close to the university. Around 5 minutes from downtown. Not as good of a neighborhood as where the condo was, but at the same time, in this neighborhood that I acquired, this 5-unit, there were a bunch of students, bunch of young professionals, and it's really, really close to downtown. And it was a good deal. I think I got a cash deal at that point, so I just kind of worked with a hard money lender.
I was going to ask you how you financed it, because a 5-unit is typically financed a little differently than a standard conventional loan, right?
Yeah.
So you got a hard money loan, and then what did you do with that hard money loans aren't usually forever, right? So
yeah.
What did you
and
do
then
after
maybe a year or so after, I was at work one day, and then the hard money guy just gave me a sudden call, and he was like, "Hey, did you know your loan kind of expires next week?" I'm like, "No, I didn't know. I thought this was much longer." But then I saved up enough money from stipends, and also from the first property, and from the rental of this new property. I had enough money to pay back the hard money lender the following week.
So it sounds like, Jerron, right? This is pretty wild to hear somebody say, I saved up enough money from cash flow and my day job to pay for the whole property outright, right? And that quick. So the cash flow on these deals must be bananas. Like, what are you seeing?
Yeah. So the cash flow on this property was astronomical, and that's because I used a couple of those apartments for Airbnb at that time.
Oh wow.
So I would rent out, it had 5 units, I would rent out a fraction to long-term tenants, and then I would rent out another fraction to Airbnb. And at that
What year was this? What year?
This was around 2012, around there.
You're ahead of your time, man. Right?
Yeah.
I mean, who was really on the Airbnb bandwagon at that moment? Not many people. Yeah. Yeah.
Yeah. And Airbnb was unbelievable at that time. At that time, when people come to your Airbnb, even if you don't provide a shower curtain or a blanket, or if you don't have curtains, you would still get a 5-star review. But now things have changed a lot.
Now you need a butler. Yeah.
Yeah, exactly. Now you need to compete with the Four Seasons Hotel. So it has changed a lot.
Yeah. If we can just take a step back before we go maybe through some other deals here, I have 2 questions for you. Generally, what over the last, let's say, 5 years, maybe up to 10 years, what has been your type of property that you really have specialized in and you've invested in? And just to give you an example of what Larry and I do here in South Florida is we really love workforce housing. We like, I don't know, some people might call it Class C housing, Class C plus. It's not in bad neighborhoods. These are working class people. These are not people that have evictions on their record. They may not have high credit scores. Maybe they're in the 600s or even maybe in the 500s. I don't really pay too much attention to credit score personally myself. I just make sure they don't have evictions. They don't have bankruptcies. They're not no serious criminal records. And, these are people that are working. These are working people. Neither Larry or I think I can speak for you, Larry, here is that I definitely don't do Section 8 housing. I don't believe Larry does either. So our neighborhoods are decent neighborhoods, but they're workforce, working class neighborhoods. So that's what we specialize in. What would you say that your assets are? And then the second question is, you mentioned that you're putting properties together in clusters. And if you could kind of explain the reasons for that and what the advantages are of having properties in a cluster.
And I'll just insert real quick. So there was a time where 50% of my portfolio was Section 8.
Oh, okay.
Now, because the market's changed a little bit and Section 8 can be annoying if you're not all in on it, in my opinion, it's I have like maybe 2 out of the 100 apartments that.
Yeah, I didn't think you were very much in that. I didn't realize that you were
away from it
years ago. Yeah.
But
I'll take the second question first in terms of why clusters. Well, since we're operating in-house management team, clusters help us with the management. If we have, say, 10 properties on the same block, then it makes our fixes, our construction upgrades, our janitorial operations, and our work orders in close proximity to each other. So we could have fewer people doing, more work orders because of the proximity. We're spending less time in traffic. Chicago is a very unfriendly city in terms of traffic. So we try to minimize the amount of time that we're driving around. And this is one strategy that helps us to really scale, utilize a small team, and still be very, very efficient. So it's like I would rather have, say, 10 properties on the same block than to have them distributed all over the state. It would be very challenging for us to go to all these properties. We would need more transportation, more people. It just makes management a little bit more cumbersome if the properties are geographically dispersed.
Another reason that I think I value clustering is you already have, when you're underwriting a deal that's next to a deal you already own, the rents. And in the market that you're playing in, as I know it, and the market that we're playing in, you don't always actually know the rents. The data is not super available because a lot of the mom and pops, they don't rent on the MLS or they just rent off of a sign they put in the street in some cases. So there's a lot of rental comps that you might not know about in a market that you might be just new to or entering. But if you own real estate down the street, you can say, oh, I'm underwriting 2 bedroom, 1 baths down the street, and I own a whole bunch of them right here. And I know the answer to the rents. I know what I can do with this, right?
And there's like differences between micro neighborhoods. You may say, it's within the same municipality or same city, like Lake Worth here in Florida, might be a few miles north and south and east and west, but moving 5 blocks away or slightly east, the rents could go up by 20%. So you really need to know your comps, back to your point though, Larry.
Exactly.
Yes. And what you said resonated with me, Larry. It makes our lender easier to approve the loan if they know that we have another building in the same neighborhood.
Yeah, and I think another benefit for us is, even though we're accumulating, we're not really flipping these properties. Owning one, we know what the comps are. Once we sell it, value goes up. The whole neighborhood, whole block, the value goes up, right? Once you have something completely renovated, you sell it, you advertise it, whatever, it brings up the whole value of the neighborhood up, right? So I heard somebody doing with single family homes where they just renovate one unit to a point where they're taking a loss. But, they take this, super high end, super luxe unit and then, take a loss on renovations, but then they sell it and all the units are just okay around it. The value just appreciates so much more to make their money on, the 5 other single family homes that they have next to it. And it's like another niche strategy that I've seen for single family homes when people buy these clusters. But I think for us too, we know what the values are. Like, hey, with investors right now, hey, renovate these units. Now the unit went from, we bought it for $55K a door to like $80 or $90K a door, right? Because we have comps, we own them, we kind of know what that looks like. So those are really good for investors to show them, hey, here's a comps directly because we own it, we know the prices, we know what it looks like. So it's also easier to get investors to show them, here's what's going on. So there's a lot of facets, and benefits from having these clusters.
Yeah, makes sense. And then the types of properties. What are you?
Yeah. So your first question, Jerron, I see very strong alignment with the properties and the markets that we target and what you just mentioned. I would say we also target workforce neighborhoods. Properties would be, maybe C plus, maybe B minus. Credit scores generally 600s or high fives. The only difference is that we kind of have a target for what we call affordable housing, where we work with Section 8 or Chicago Housing Authority or other subsidy programs such as Housing Opportunity for Women or Chicago Housing and Health or the Veterans Association. We believe that this helps our business to be recession proof because these rents are kind of guaranteed and the increases per year are also guaranteed as well. So for example, this year, the fair market rate for 2 bedrooms in the areas that we are operating is around $1,700, while the market rate would be maybe, let me do a quick math, maybe even 30-40% less than that.
Wow. So you're saying Section 8 or some of these other public subsidies will pay you 30% or more rent per month than what the normal market rate might give you in that area.
Yes,
wow.
Guaranteed. And our portfolio now is around 27% of subsidized tenants, but our goal is to get the portfolio to maybe 40-45% subsidized tenants.
And what's the challenge what is the challenge to get there, to get from 27% to 40%?
Well, the challenge is one, finding people who have these vouchers or getting the apartments in front of these people who have these vouchers.
Okay. Do you have a method for that other than the bit I know about Section 8 from my clients that use it is you get on a list, some type of public website for Section 8 rentals, and then they can go scour through those rentals and a tenant who has a voucher can look to see which ones they want to contact. Is there any way to proactively contact these people?
Yeah, we have targeted marketing campaigns that focuses on, bringing the apartment to these people, not just via the website, but there are also lots of local offices for subsidy programs in Chicago, such as the Housing Opportunity for Women or Feather Fist or Inner Voice. And periodically we send them a flyer once a quarter to let them know, hey, we're still alive, we're still operating. And whenever we have a spike in vacancy, let's say a spike, we're not even, considering percentage spike, but let's say we have an actual spike. Maybe suddenly we see that, hey, we have 10 units vacant. Then we have these flyers that are automatically disseminated to these addresses. So we get the apartments in front of these people.
I'm fascinated with this Section 8 business because it's really something I don't deal with. And I as an attorney in our law firm, we do around 300 or more evictions per month in Florida. So I only hear the problems that come from Section 8. I know the benefits conceptually. Obviously, things that you're talking about here, guaranteed rent every month, many cases, stability, tenants that don't want to lose those vouchers, so they don't want to be evicted. So I know a lot of those benefits, but I guess, just to understanding this a little better, do you try to create relationships with the Section 8 housing folks at Chicago Housing or the different? Do you go in and bring donuts in
Could you repeat that, Jerron?
Do you try to create relationships with the Section 8 housing officials? Do you bring lunch or donuts or go in and bring them coffee or just walk in the office and get to know them or schmooze with them at all? Is that something?
They themselves are skeptic of forming relationships too because of conflict of interest.
Okay.
But we build our relationship based on trust and based on, us making the units livable, us taking care of the tenants, us showing the tenants that we care. So we kind of go above and beyond to make these tenants happy. So instead of just renting them an apartment and disappear, we kind of, making sure that they know where the healthcare services are in the neighborhood, the daycares are in the neighborhood. Maybe there are some soup kitchens in the neighborhood. So we kind of pass out these pamphlets and, just try to build a relationship. And we have a philosophy that regardless of if you're a market tenant or your subsidy tenants, a happy tenant is a good tenant.
Makes sense.
I agree with that.
Yeah.
I tell my clients that all the time too when I'm representing them on higher end leases and stuff. My manager manages all our workforce housing stuff. But I tell them all the time, they're asking for something early in a lease. Just if it's reasonable, just go appease them. You want them to be happy. You don't want to go to battle with your tenant. Like that's not the goal. So put in the wire racks in the closet, right? Yeah.
Besides reputational damage, but it's also just for me, one of the worst scenarios is having those vacancies and losing a tenant that may have been with me for 24 months or 36 months or 48 months. And maybe something happened and they got dissatisfied and they want to move. That I don't want that, because the cost not only of losing that rent for maybe a month that I've got the turnover before I can find the next tenant. So I lose on a month there, then I have to pay some real estate commissions to my property manager to go place the tenant. That's the second cost. And the third and biggest cost, at least here in South Florida, is our rehab costs. I mean, it's not cheap to rehab a property. It's thousands of dollars for us at least. So, but anyways, yes, I agree with what you said there, Larry and Leon.
Another comment I was going to make around what I found when dealing with housing authorities is the individuals that represent or help, and I'm forgetting the name that they use for themselves, but there's different people in the offices. And usually when you do a deal with the tenant, they have someone at the office that's helping them get this through, helping process the paperwork and all that stuff. And if you do a good job with them, like you said, Leon, and you're super responsive, or if an issue pops up, or hey, I'm guessing you guys also have inspectors that come to the property and verify, right? And so there was a time where we knew all the inspectors. We had relationships with the inspectors, and they would come through and they'd say, "Hey, Larry, we know you take care of all these things. Just knock it out. Here's the list." My guy would knock it out within 48 hours, and then get back to them, and then they'd come back out and inspect. And when you're really efficient with the communication and you handle things properly, they like you and they reach out to you like, "Hey, I got another tenant. Do you have any other space?" Right?
Yes.
That's what I found.
Yes, exactly. Yes. And sometimes when the tenant kind of complains about, say, stuff that are broken in the apartment, if you respond fast and take care of it, then it kind of builds trust, and they will bring you subsequent tenants as well.
Good point. Yeah, you can word of mouth is helpful amongst the tenants for sure. So I don't know if this is jumping too far ahead, but I'm super curious to understand how you think about investing a little bit more, like metrics wise. What looks like a good deal to you guys? And that's a broad question, but let's dig into it, and then Jerron and I can share what we see here and how we think about investing and what looks like a good deal to us down here, because it's a little different, as Sebastian alluded to earlier.
Yeah, I do have 2 PDFs with kind of our numbers I can share with you guys. Just going to show you guys one of our examples, what it looks like over a year. And awesome. Also can show you guys the first property multifamily I purchased with Leon, what that looks like. So you want me to send it to you or just screen share?
Are you able to hit the present button down below or no?
Yes, I can.
In the meantime, do you want you want us to talk about selection? How do we
Let's
select
talk
the
about it.
property?
That's great. Hit it.
Yeah. So as you know, in real estate, there are a gazillion matrix, and we cannot keep track of all of them. So I have my favorite tool that I utilize to make a decision. And I normally go for the cash on cash on the cap rate.
Elaborate on that. You focus on cash. Is this after stabilization? So after you increase rents, maybe add value, or
No. I normally say what will be my cash on cash immediately at purchase.
That's a crazy concept to Jerron and I here in South Florida. That doesn't even exist. Cash on cash at purchase? No. So tell me a little bit more about that. That's super interesting.
Yeah, so I would say before 2 years ago or a year ago, my matrix would be, hey, I'm looking for a cap rate, say not less than 8%, and cash on cash not less than maybe 18, 19%. That would be my criteria for even looking at a deal. And there were lots of such deals in Chicago, in this area. However, since a year or so ago, things have kind of slowed down a little bit. So I have to become a little bit more flexible in the numbers that I'm looking for. So now I would say cap rates of, even 7 or 8% is what I'm looking for, and cash in cash in the teens, in the 15, 16%.
And so day one, when you close on that deal, that property is 15% cash on cash return you're getting, correct?
Yes.
I mean, that's amazing from our perspective down here. Now, obviously, that's a metric in isolation, and there's other metrics to talk about. But so tell me this: are you guys seeing a lot of appreciation in your market year over year?
We're seeing appreciation, and maybe we're seeing natural appreciation. But in the kind of markets that we're operating in, we also do value add. So we are buying at maybe 50, 60,000 per door at closing. And then whenever we have a vacancy, then we would do the floors, do the kitchen, do the bathroom. And at that time, then we know the value add there, it would cost us what? Maybe $10,000 per unit to do the value add. 10,000 is an overestimation, I would say. So maybe 8, 7,000. But then we would realize values of maybe 75, 80,000.
Got it. So you're getting the appreciation bump from the work you're putting in, raising rents,
right,
improving the property. But on average, is your market appreciating there?
The market always appreciates. The market almost never depreciates unless it's major events such as the recession. But in terms of a number, I would say maybe a 5% appreciation outside of the value add. So just by market conditions, maybe 5% appreciation, I would say.
And so that leads me to the next question, because I'm just comparing in my head our deals to your deals, and I can elaborate for the viewers. But that leads me to the next question: what does the financing look like on deals like this that you're doing deals at closing, 15% cash on cash return?
Well, the financing, it's normally for 25 years. We normally use traditional banks, and our rates are typically now we're seeing high 6s. Before it was low 4s, high 3s, around about there. And I would say around 80%. Around 80%. The bank would give us around 80%. So
Today, will they give you 80% on a deal as well?
No, we are getting 75 these days.
75%, which is still very good because South Florida, it's hard to pull off 75% here.
It's very common here to get 75. All the deals that Zaba and I have done, we have gotten 75%, right, Zaba?
Richard might have gotten 80, so always push for 80. So we negotiate with our lenders. But yeah, we got the last deal we closed at 6.7%, 6.7 interest rate, and 75. The one before that was 75% at 7. So actually we got a smaller rate this time around. And then the first one we got at 6.7 at 80%, if I'm not mistaken.
So the last deal you closed in February, how big was that? How many units?
That was 16 units.
16 units. What type of financing? What bank did you go to do something like this?
I had a local bank. It's Providence Bank. So
okay,
it's like
regional bank. They financed it. You mentioned 25% amortization, 6.7% rate. What's the term on a loan like that you're doing up there? 5-7 years, something like that.
5 years. It's the 5 years. I mean, they're getting fancy, right? So it's kind of like a 5 year, and then they give us a free refinance depending on the rates.
Yep.
So it's kind of like construction, but a 5 year, 25-year amortization rate.
Got it. Okay, that's pretty good. 6.7% is pretty good.
And what are your insurance costs there? Do you have a metric for that?
They just went up, so we're negotiating. But so previously,
like per door, maybe if you could do per door.
So Richmond was 400, 300 per door.
Just for context, guys, let me just blow your mind right now.
That's 300 per door per year, right? You're saying
it's per door per 350 or something, right? So we pay about, it was 4,000. I think it went up to like 6,000 right now for a 10 unit. So you're talking about roughly, $500 per door
per year. Yeah. Okay, so per door per year here will range from. Jerron, correct me if you have better terms. We use the same guy. So it just depends on the building, I think, at this point. I think the cheapest I'm getting is maybe I got lucky on a couple of them, but like $1,800 per door per year up to $3,500 per door per year, depending on the asset. So
that is mind blowing.
Okay.
Yeah. Yeah, I think my best is about $1,500 per door.
Is it because of the risk associated with adverse weather conditions?
That combined with lack of competition in the market, combined with welcome to South Florida, fraud. Fraud's crazy. But if you move out of South Florida, like we have assets in Fort Pierce as an example, insurance gets cheaper. It gets cheaper there, maybe more like $1,000 a door. Is what we've seen. So again, it depends on the asset, depends if you have impact windows, depends on the roof you have. There's so many factors that go into what might make you pay more or less for insurance.
But also keep in mind, we got to compare apples to apples. Our 2-1s and workforce housing are going to be around $250,000 per door, not 60, 80,000 like you guys have. So it kind of, if you want to do it based on purchase price, per door price, then maybe it starts to look a little more comparable. So, yeah, it depends how you crunch your numbers.
The reality is we're talking about metrics in isolation, and you can't do that to like just decide, South Florida's out, right? Or to say that most of my deals that I underwrite, I'm underwriting 0 or negative when it comes to cash on cash returns day one. So most of the stuff
for us, if we see 0 or negative, we would not even look at the property.
Well, your market's very different. Yeah, it's very different. Yeah. So our market, if you want to do a deal, in most cases, it doesn't make sense on paper day one. You have to add the value, you have to increase the rents, and then maybe it makes sense. And in most cases right now, it's very hard for that to make sense too. So
not a lot's making sense right now, especially because the appreciation which we saw, we saw significant appreciation going back all the way to 2009 or 10 after the market had dropped here by prices 30-40% in some cases, some areas. And then we saw starting the slow climb from, let's say, 2009 or 10, moving up, the slow climb. And then, of course, with COVID, prices went absolutely insane here, and with people in capital flowing to Florida, So, properties that might have been selling for maybe similar to your prices, these 2-1s maybe 15 years ago might have been selling for 60 to 80 a door are now at 250 a door. So it's been a pretty crazy run up. I think that run for right now has more or less stalled out. Would you agree, Larry? You're the broker here, but the price appreciation for now, more or less with multifamily, has somewhat stalled. Would you agree with that analysis?
It's stalled.
And
your point is right. In 2015, I paid 50 or 60 a door for 2-bedroom, 1-baths, right? And I might have been overpaying at that time. I've developed my expertise further since then. And so I would argue maybe I should have paid 40 to 50 a door. So you could have pulled that off back then in 2015. Now those same assets are worth probably close to 200 a door. Yeah.
And so what we're comparing is South Florida, where you got into it because of price appreciation, not so much because of cash flow, and certainly not now because of cash flow. Whereas in your market, significantly less appreciation over time if you compare that on a 15-year curve, let's say, but cash flow much better. And where we are in this market right now, I mean, nationally, you guys are a great place to invest money. I mean, that's my summary based on the initial things that we've discussed and what I've heard on this podcast. When people have money to invest, if they can get 15% cash on cash in a given year, that's fantastic, rather than putting their money maybe somewhere that maybe it's going to stall for this moment. Now, maybe in a year or 2 years that changes. Maybe we go into a recession, or there's more, vacancies, or those things can change at any given time. But you got to weigh what an investor wants. Do they want the cash on cash, or do they want to hold a property for 20 years? And maybe in 20 years, these properties in South Florida are going to be worth $500,000 a door, $600,000 a door. So,
or maybe they're underwater.
Well, my conclusion here, Jerron and Larry, is there is really no clear winner, between what's going on in the Midwest and what's going on there in South Florida. While in the Midwest here, we're seeing high cash flow, we're seeing maybe slower appreciation without value add. While in South Florida, you get the appreciation right off the bat, just based on your location and based on your the kind of people in that area. But on the same time, your cash on cash may be a little bit restricted.
Yes.
If you manage the deals properly and you play the right game here in South Florida, you can see huge cash on cash returns over a 5-year period if you've been playing the game properly. For us, the way me and my partner were able to scale to 100 doors was we structured deals where we refied every few years. And because rates were low and values were climbing, and we added value and boosted the rents, we were able to pull a lot of cash out. I mean, most of the deals I have, the original cash we put into those deals is gone. So the returns we are experiencing right now are infinite, if you will. We have zero cash in a majority of the deals. We used to underwrite deals. The model for us was, can we buy this and can we pull anywhere from 40 to 80% of our cash out within 2 years? And so that's what we were doing. And in a lot of cases, we were conservative. So we were pulling almost 100% of our cash out of those deals after 2 or 3 years. And so that model worked. The Burr method worked. So that's how we were successful here in South Florida, because you can play the appreciation game. And you guys are playing the cash flow game really successfully over there, which, sometimes I wish I had the cash flow instead of these like massive checks from refinances. And now obviously interest rates are higher, so that becomes much harder to play that game.
Right. So we have also refinanced. We play the refinance strategy every 2 to 3 years as well. So we have also refinanced some of our properties, not since the interest rate, crossed 6%, I would say.
Same.
But even when it was in the mid-5s, we did refinance some of our larger properties, and that's what we're using now to kind of scale the portfolio. So it's not, in my mind, again, diversity, the guy that does diverse portfolio will be the clear winner. I think that, we need to have properties in different markets so we can realize the cash flow benefits and also realize the appreciation benefits as well.
Yes.
And that's why I told Sebastian, jumping on a plane with him next time he goes to Chicago. So,
but it also, too, like, kind of, as I mentioned before, it's also based on the investor's needs. So an investor who maybe is 62 years old, 65 years old, they're knocking on the door of retirement. Maybe they really want that cash flow. They're not so concerned about appreciation over 20 years because they don't know if they're going to be around in 20 years. So they want to go on cruises 4 times a year. They want to give their grandkids presents and spoil them, and they want to travel the world, and appreciation may be their number one goal. Cash flow may be their number one goal. And you guys are a perfect fit for that. Whereas maybe someone's 45 years old, they're in the prime of their career, they've got some money that they, want to invest, and they want to sit on it and maybe play this burr game. If not right now, maybe in 3 years, interest rates come down and then prices start to really ramp up again. And maybe South Florida is the right fit for them because they're in a little longer term mode. They don't need the cash. Maybe they've got a business that gives them the cash flow that they need for their life, or they're a professional and they make a good salary. So it's all based on the needs of the individual, at least in my perspective. So, yeah.
And to your point around that, Jerron, I would say what I experience most is you have people relocating to South Florida. There's a positive population growth here, and a lot of them want to bring their investments with them. So they may be coming from California where they have 10 properties, they 1031 exchange into this area, or they're relocating from Brazil or Turkey or other places around the world. And they come here. It's a very international place, and they try to do more investments here. So they like that locality to the deals they're doing because they're small mom and pop investors. And that's part of what's been driving the prices up here. On top of like all the tax strategies that people have been using that I do a fair amount of business because of, right? Accelerated depreciation, cost segregation, that type of stuff we're seeing happen here, which increases competition and drives prices up. And the inventory here is generally low for the type of stuff that you guys are investing in and we're investing in. Yeah.
For sure.
Yeah. Just going to add to this whole depending on investors, right? Depending on what you want. With investors, what we're trying to do is also with friends and family, they all want cash flow, right? Everybody wants, it's kind of nice because of a hybrid model with our investments. So last deal, how we structured it, I guess is a good segue into it. The syndication, what we did, we structured such a way where we matched S&P 500, right? Where once we have a capital event, meaning we're going to refinance it or sell the property, the investors get 1.5 times their investment back, right? And that event horizon is 2 to 5 years. In the meantime, they're collecting half, getting a rent split, right? And that rent split is tax-free because we depreciate against, the building, and it can afford a lot of those tax savings to the investors. So you should get a tax-free check every 3 months in the mail. So depending on how fast, we're going to get this stabilized, we're expecting checks between, at the beginning, maybe $900 to $1,000 the first quarter, and then they could go up to like, with 2,000 to 4,000, depending on the performance per investor, per $50,000 invested. So essentially, you invest $50,000 into 5 shares or 5 units that we call it, and after 5 years, you'll walk out with roughly $110,000 to $130,000, depending on the performance. On top of that, you're going to pay taxes on maybe $30,000. That was a rough estimate from the attorney I talked to, but this is kind of the structure we get. Because it's kind of nice. If you have investments, you have your 50 kids. The money's not frozen. You're going to see it, right? Every 3 months, every quarter, assuming everything goes well. It's not promised, right? Because there's repairs and just a bunch of stuff we can talk about too. But you're getting cash flow, right? So the money's not frozen there. You can make your car payment with it or whatever you want to do, save it, right? So it's kind of nice because your money's sitting there. You're getting the check every 3 months. We have a touch base with the investor. Hey, here's a check for you. Everybody likes that, right? It's going to build that connection there. And for our investors specifically right now, it's the cash flow that really counts, right? But you get both. You get both ends, right? You might not get a crazy appreciation, but we're essentially matched S&P 500. We double your money every 10 years. After 5 years, you get 1.5 time investment back. Plus, you get the cash for the meantime.
Love it. Can you explain the tax-free part of that, where you're only, let's say they invest 50, they get back, let's say 120 in the middle of your estimation. How are they only paying taxes on the 30,000 of the 70,000 in money gain that they've had? How does that work?
So because we're depreciating the building, I think we get like 18,500 credit a year, right? So as long as our operating expenses with paying out to investors do not exceed our profits, those payouts are tax-free. So collecting, the rent over 5 years, you collect around, again, depending on performance, between $50,000 and $60,000. And then the $50,000 you put in, so it's not capital gain. So you're only paying taxes on the amount that you actually paid off, right? Because the capital gain, the amount of the building that was paid off, minus the $25,000 extra that you're getting from our payout as a capital gain. So you're not paying any taxes on the rent as long as our operations do not make more income than what the payouts are. I have the whole formula written down I can share with you because I had to talk to the attorney to make it clear.
Okay.
I have it written on a napkin and I have it formalized somewhere, but it's the idea essentially.
No worries. But if someone had questions about that or they wanted to reach out to you, you could certainly walk them through that and explain the whole.
Absolutely, I have the whole calculation now. But the idea is that we depreciate the building every year, and then the depreciation goes into those distributions that the investors get, and those then they should be tax free.
Okay, excellent, good stuff.
Are you guys cost segregating your deals, or are you just straight line depreciating them over a period of time? What's the typical play there?
I think we're just depreciating them over time.
Okay. Yep. We've heard a number of investors have different opinions on that, right? So it's just, that's why I ask. Yeah.
And lately I have a bunch of people reaching out to me about the cost segregation approach, but I haven't had time to really focus on which approach is better for us.
It's more about what your investors want. Exactly. So it depends on, do they want that big loss right away, or the tax loss right away, or not, right? So yeah. Interesting.
Did you want to share some numbers there, Zaba, with us, Sebastian?
Sure. Call me Zaba. It's so much more efficient. I'm German, real about efficiency, right? Soul that's inefficient, right? But I just added a soul in the past year to me, so get the best of both worlds. Let me share. Present. Share screen. Share screen. All right. Let's see here.
While you're sharing, you feel free to pull it up, and then we'll switch to that. But what's your goals, guys? Where are you headed? What do you want to do next? And what's the plan?
So now that we have done syndication, we have a number of aspirations, and one of them is to start getting bigger units. There is massive opportunity in downtown Chicago with high-rise apartment buildings. So that's one avenue that we're looking into. And also, we are also thinking of having a construction arm where we would build from ground up, like luxury condos, and resell them. So now is just an exciting time for us, and we can go in so much direction. We can continue on our natural trajectory, which we plan to do, but we also want to kind of grow in other areas as well.
Yeah,
that's exciting.
Yes, definitely operations side. So definitely Leon is, heading that and spearheading it, and his amazing ideas. But what a big change for us too is going to be how we raise funds, right? Like I said, I just came back from the Raise Fest with Hunter Thompson, and the way that people are raising funds these days, staying away from these big institutions and get like investors to kind of pool the money. So we're going to start doing fund of funds, or special fund vehicles, and kind of get the money in there so we can actually get most of it sponsored without any of our own money down, right? So we're definitely going to keep doing refinancing, but also last deal, well, theoretically was zero money down from our end, right? We can talk about some of those hiccups, but in theory it was zero money down out of pocket. And after refinance and everything else, we're gonna, the investors will be happy, hopefully reinvest with us again, right? And then, we're going to own the property after 5 years, because we're planning on not selling it, but refinancing it, paying everybody out, and then kind of keep growing the portfolio. So the way we raise funds and how we do this definitely going to super exciting, right? We talked about, raise $300,000, maybe $1 million. And now we're thinking about raising at least 10, 50 million this year from investors to kind of put down for properties. So it's our goal for this year. So hoping to get a few million by summer, and then we're just going to grow from there.
I love it. I love it. Let me add this to the stage here so you can share this. And then maybe my final question is just like, I'm just curious, your deal flow, how you're sourcing these opportunities, how much opportunity are you actually seeing? So, Sebastian, let's get to your thing first, and then we can circle back. Can you guys see that clearly?
Yes.
Cool. So this is the property so my first property was Leon, acquired in end of June, July. And kind of give you an idea of what the rents were. I don't know if we can go through all the details, but I can just scroll down.
The rent roll as well, Zaba, so we could
just hit the high points, I think. Yeah.
So it's kind of the net income. Right? The nice thing is, how many units did we renovate in Richmond, Leon?
For Richmond, maybe one. We have had only one vacancy. So
we renovated one unit in there. We're able to paint the hallways, beautify the outside, kind of take care of make it nicer. And it was zero out of pocket. We didn't take any distribution. We put all the money in there. So once this property was 10 doors, I believe we paid $535,000 for it. Right. So roughly, $54,000 a door after, attorney fees and whatnot. And then month one, we walk out with $200 in the bank. Right. And that usually has some money left over for renovations. Then you see, months two, we got $1,100 left. And then I think this month I paid the insurance up front because it's kind of battling. So the monthly plan. So that month I'm like, okay, let me just pay the insurance for the year. So I see a negative here. And then this one might have been, the first month rent, we had to pay somebody, right? It was with the vacancy, it was cleaned up. We submit, $100. So cash flow month one, right? So the first year after we bought it, between July and December, including beautifications, renovations of one unit, we are left with $2,000 by the end of the year, right?
But that's just from the cash collected. This is not showing that some tenants were late. And right now, I think for that property, I think we have maybe over 7,000 or 6,000 something in tenant balances.
Wow.
Yes.
Okay.
And then also January, February, we got subsidized tenants would get the money in, right? So the rent went up by $1,500. So I don't have January, February up here, but the monthly cash flow is. Do you remember, Leon? It's probably at least $2,000 or $3,000 at this point.
Yes, and just to be clear, we have not raised rents yet. Rents are the same as when we purchased the building. However, we have improved common areas. We have sent out our rental increase notices, and in 2 months we will raise rents. So we are looking to cash flow from this property around, I would say, around 3,000-4,000 a month or so.
Yes, and we're because we care about tenants too, right? So we specifically not raised the rents out November, December. My Christmas was coming up, Thanksgiving, which usually we buy a property, we start putting money in, beautify it, and they get a rent increase within the first quarter or so. Once we do all the renovations, we held off, actually 3 months because, hey, let's not stress these people out during the holidays. Let's give them a break. We can wait. It's cash flowing positive anyways. Let's wait till January to kind of do all that stuff and raise rents. So there's a little bit of a delay here.
Yeah.
Another point here is that in this building we have 90% market tenants and only one subsidy tenant. If this building starts to match our desire, giving us, say, 40% subsidy tenants, then we will be well on our way in terms of cash flow.
Yeah, again, this is slightly delayed again because we didn't raise the rents, but also usually once we start raising the rents, we get people leaving, right? So usually as soon as they leave, we try to get the subsidized housing markets in there. So that's why you don't see that as quickly here. But regardless, this is a delayed deal, and we have cash flow for month one, and end of the year we walk away with $2,000, and the investment that's first 6-7 months. That's the first deal, and then we have one deal, the Dobson one, that we use. It's like a more of a standard deal that we have to stabilize to a degree. We have full year numbers here. The reason why we see this increase right here in operating income is because we switched to our in-house software, not in-house, this software that we used to use from the other property management company. So that's why you see kind of, the first couple of months aggregated in April. But if we ignore all this, we can talk about the total numbers here, Leon, since this is mainly your example.
Yeah. So how many units?
This building has 12 units.
12 units. What's the unit mix? Bedroom, bathroom?
I would say it's an even mix between twos and ones. Mostly ones, I would say. There's a few twos, mostly ones, and one studio.
Okay. Single story, 2-story building. What does that look like?
It's a 2-story building, and I could send you a picture if we.
It's okay. I'm going to give you my rapid fire questions that I hit every broker with when they say I got you a deal, and I'm like,
it's
okay.
a 2-story building. Shoot.
All right, great.
Shoot, Larry.
All right. So do you have washer and dryer in these units?
No, these units do not have washer and dryer. This property does not have on-site laundry.
No on-site laundry either.
No.
Okay. How big are the units on average, or how big are the 1-1s, and how big are the 2 bedrooms? Two.
I would say maybe the 2 bedrooms are around maybe 1,100 square feet, and the 1 bedrooms are maybe 1,000 or so.
That's pretty good size compared to what we were buying down here, just for reference. Okay, cool. And do you know the price per foot? What you guys paid? What was the price you paid? And do you know the price per foot off the top of your head, or where you're about?
I don't remember the price per foot, but I think I paid somewhere around the 600,000 for this property.
635.
635. Right.
So what's a good price per foot in your area? Like, where would you guys?
I normally don't do the price per foot. I normally do the price per unit, just to keep everything simple, so I can move very fast.
Copy that. What was the price per unit on this? 63,000 or something?
No. It's gonna be around the 50s.
50s.
Around 50, yes.
Okay, so you're paying like in the 50s per door on average for.
That's my target for now.
Yeah.
53, yep.
For 2s and 1s mix. Okay. All right. Pretty cool. And what did you guys underwrite a cash on cash return for this one? What did that look like initially?
Well, at underwriting stage, I think we were at maybe around 20% cash on cash, because this property came with some subsidy tenants already. So when we bought this property, we had a couple of move outs, and we just kind of replaced them with subsidy tenants as well.
Okay, and you bought this in May of April of 2023 or something, or is this?
No. This property was bought maybe in 2022 or 2021, somewhere around there.
Got it. Okay, so
but we started in-house property management using Upfolio in April of 2023.
Got
so
it.
That is why you see January, February, and March all accumulated in April. If you look, April total operating expense is 20,000. Versus May, it's 6,007. The 20,000 is an accumulation of January 2023, February 2023, March 2023, and April itself.
Okay. What about utilities in buildings like this? Does the tenant pay for water and electric, and is there gas up there?
So this building is pretty unique. This is a fully electric building, so there is no gas. So even the heat is powered by electric. For my subsidy tenants, I like to include utilities in the rent, or at least heat. I don't want to put the responsibility of heat on subsidized tenants in Chicago, where the temperature drops and this one person did not pay their bill, and this unit water gets frozen and it impacts the entire apartment. So whenever I have a subsidy tenant, I like to incorporate at least the heat. And more of the buildings that we're buying have a furnace in the basement that powers the entire building with heat. So it makes it really attractive to get subsidized tenants because we are including the heat naturally.
And when you add the heat, I mean, when, at least from what I remember from doing these Section 8 deals and these subsidized tenants, you fill out a piece of paper and it's like, what is landlord paying for? What is tenant paying for? And then obviously maybe the base they're willing to pay is $1,700, but if you add in heat, they're willing to maybe pay $1,800 or whatever the number is, right?
Yes.
Exactly.
Yes.
So you get it covered in the subsidized housing. While we're talking about subsidized housing, what is there percentages that the tenants have to pay, or is it 100% subsidized in most cases?
Yeah, I only work with the subsidized programs that pays 100%. I don't care what goes on in the background, whether the tenant has to pay the subsidy agency a percentage in the background, but we get all our payments from the subsidy programs directly.
Interesting. Okay, so down here, how I've experienced it, maybe there's other people that have experienced different, but usually it's a percentage. So, and I have to deal with collecting that difference. So I have to, and that varies every year or 6 months, depending on how the voucher plays out with the housing authority. So if, say, they lose a job or they get a new job and they get more money, then their voucher changes, and then they notify us, hey, you're not collecting $250 anymore, you're collecting $400 now, and we're only paying X. And that's part of the reason why I don't like dealing with them, because it complicates my life.
Yes.
We got to figure out how we're doing that. Now I have a management guy that does this, but it's still more complicated for him. And so,
and I would say that is true, Larry, for Section 8 CHA. But as I mentioned, we're using lots of other local programs, and these programs pay 100% directly to the account or via a check mailed to us. That makes management much easier. It makes our financial interaction with the tenants nearly zero, which is what we want. All we have to do now is keep the tenant happy.
Copy that. Yeah, that's great. That's great. And it's just direct deposit into your account every month, right?
Well, some of these programs does direct deposit every month. Some of them are not that sophisticated. They will mail you a check.
That's been my experience with those programs too, which if you don't have a system like you guys have set up, that can be frustrating for example, little Larry here, who might have had at that time, I don't know, 50 doors. It was still annoying to get 25 checks every month, right? And and the system wasn't put together perfectly. So we're chasing the companies for checks. We're chasing the subsidies companies, because we've worked with different companies that also paid 100%. But again, that was our experience too. They were sending us checks, getting lost in the mail, sending whatever it was, just stupid problems. So yeah, you have to build a system.
Yeah, I do have a question for those that are not subsidized. What is the eviction process like in Chicago, and how often have you had to do evictions?
So I would say eviction is a continuous process for us. The eviction process is very seamless. We work with Halstead Law Group, and the attorneys at Halstead Law Group, they're very versed in eviction. So the way it works is as follows. If there's a tenant that needs to be evicted, we have an email address that we would send the tenant ledger and the eviction documents that has been endorsed by the notary public. And we send everything to this email address, and that's it. We never got involved again. And by the next 2 months, maybe 3 months, the tenant is gone.
That quickly. In Chicago, 2 to 3 months, they're good.
Yes.
Wow. Okay. I don't know why I had an assumption that it was a little longer process like New York and California and some of these other states.
No, it's definitely not as long as New York. It's much faster. I have some friends operating in New York as well. And that's one of the hiccup in New York, I would call it tenant friendliness with the
California too. A lot of states now. So yeah. Okay, good. Excellent. Well
there is no rent control in Chicago.
Okay.
And there is rent control in New York, maybe California, but in Chicago, that's something that's being discussed. but it has not been approved or anything like that as yet.
Okay.
So instead of dealing with those headaches, just invest with us, fund on funds or syndication. You deal with nothing, just collect your money,
That's it. Easy.
That's the service you guys offer for sure. Absolutely.
That's it.
Absolutely.
That's the true value add.
So the 1-1s on that deal you just mentioned, what is the market rate on a 1-1 there, and what's the other rent that we talked about here, the subsidized rent?
For subsidized rents, the fair market rate for 1 beds is around $1,500 to $1,600 in the neighborhood that we operate.
Okay.
The HUD fair market rates vary by region. In our region, $1,500 to $1,600, and then I would say the market rate would be $950 or $1,000 around there.
Got it.
For those neighborhoods, yes. However, if you go downtown Chicago, you could get 1-bedrooms for $3,000, right? But that's not the market we operate in.
So you're saying the subsidized rent is $1,500, and if you just grab somebody that came straight to you off the street, $1,000, $950? Is that what I heard?
$950, $1,000.
Wow, very, very different. Okay.
Very different. I would have to maybe work hard to find someone for $950 or $1,000 as well.
Wow. Yeah. Okay. And there's enough tenants out there. They're going to keep renting. You have good relationships with HUD and
Yes.
Okay.
We have direct target marketing campaign targeting these programs, these agencies where quarterly they get a flyer from us, and as we see a spike in rental, they get another flyer. So we have a periodic marketing, and we have one that is event driven based on vacancies.
Got it.
Yeah.
What about sourcing deals? That was my I don't know, final question. Yeah.
Sourcing deals, I find it to be the easiest part of the work.
Wow.
Yes, and that's because I have so many people coming to me with deals. Right now I know where I can find maybe 3-4 good deals, but because we have one under contract already, we're a little bit patient. But as soon as we close that one, then we know where to find the next deal from. There are lots of brokers in Chicago, and we have a great relationship with them. Periodically, we go in and we do presentation for the brokers to show them our strategy, to show them the portfolio. We also have presentation for our lenders as well. Like, in December, we have end-of-year presentations where we present to, Providence Bank or the community banks to show them, how the team has evolved and how we have utilized their money. And that kind of fosters close relationship.
Interesting.
Yeah. And but the nice thing too is, with buying the similar neighborhoods, as soon as we purchase a property somewhere, we have the brokers knocking on the doors literally and ask them, hey, we just purchased, you got a good comp, do you want to sell? So actually, Indiana, we bought it, right? Because you have the building right next door to it. So Indiana, Sam actually went there knocking on the door and asked if they want to sell it. And then that's how we ended up with that unit. So the brokers are knowing that if we put something under contract, we always close. Right? It's kind of a reputation that we build. At the same time, we have literally brokers going out and knocking on doors. Hey, Steneth Capital bought these buildings here, and they're just knocking on doors, seeing if they get mom and pop to sell it. So that's why the sourcing got, it's pretty nice.
So you work mostly through brokers. Is that what I'm hearing?
I don't have a dedicated broker, but a bunch of guys have properties selling, and they're always in contact with us. They bring the deals to us.
Sure.
Yes.
Yeah, they know you're a buyer, so all these brokers in the market, they'll reach out to you and provide opportunities, right?
Right. And most of these brokers too, they have the link to the sellers, direct contact to sellers.
But you don't have a cold calling team or a mail marketing platform where you're sending stuff out trying to source off market deals. This is
no.
This is, you have a network of killer brokers out there that are just hunting for you.
It's pretty crazy these days. These days I have to be dropping the calls from the broker because I'm not ready for the deals.
We have
I have to be dropping calls because they have so many deals.
Unbelievable.
we have a team of Larrys, you know. Basically, we just got really lucky because Larry's killing it out here. We have a team of Larrys now in Chicago.
Yeah. So this is what I realized. So Chicago is one of the bigger cities in the Midwest. So you have a lot of brokers like from the Michigans or the Indianas or the Ohios, and they come to Chicago and they hit the ground running. They're highly motivated being in this big city, and you know, they are just cranking and crushing it like a rock star. Yes.
I love it. I love it. That's wild. So for context, here in South Florida, you know, Jerron and I have a network of brokers that we work with as well, and other individuals, wholesalers, you name it. Anybody who's out there that's hunting, we'll interact with and see if they want to work with us or bring us opportunities. And I just say we don't have an influx of deal flow. It's not the same. Yeah,
I see. Yes.
Well, do you guys have anything else you want to leave us with? I feel like we've gone through everything.
Well, I would say that, you know, very, very happy to be with you, Larry and Jerron. Thank you so much for the invite so that we could explain, you know, our secret sauce on how things work. I definitely learned a lot about the South Florida market as well. And I'm looking forward to coming down to, you know, meet with you, Larry and Jerron, to shake hands and, you know, have dinner, have a beer, hang out. And looking forward to see you guys in Chicago whenever it gets warm.
Yeah, I think that's the target, the warm months. And yeah, you're welcome anytime. Let us know when you're coming into town. So
sounds great. Exactly. Yeah, this is perfect. And kudos to both of you on creating a nice system that you're really ramping up here. And you're sounds like you're really putting systems in place to make this very profitable venture, not just for yourselves, but for your investors. And hopefully you'll get some folks that'll contact you. We'll put your contact information in the description of the video. But if you just want to share here, if anyone wants to, reach out to you, do you have a website for Steneth Capital or anything that they
Yes,
can?
we do have a website. It's www.stennethcapital.com. We have a Teams page with our numbers and our email. You know, feel free to reach out to us. Zaba is the lead for joint ventures and syndication. So I would advise investors to just reach out directly to Zaba. I'm more on the operations side of things. So
perfect. Good.
Yeah.
Well, we've learned tons from you here today. So thank you, gentlemen. We appreciate it. Thank you, Larry.
yeah, and thanks all the viewers. Thanks for tuning in again, guys. If you liked the video, like, subscribe. There'll be much more content just like this coming out, and we'll see you guys on the next one.